Welcome to Honest Money, your best guide to financial freedom. I'm Warren Ingram, the author of a few best-selling books, and I'm also an award-winning financial planner, and I've helped thousands of people on their journey to financial freedom. I'm not here to tell you what to do, but I am here to share my experience and the best ideas that I've learned, and I hope these ideas help you on your journey to financial freedom. Welcome to Honest Money. Today we're going to be discussing, or I should say listening to your questions that you've sent to us on WhatsApp. Thanks so much for those questions. We really appreciate them, and we'll do our best to give you sensible answers. I'm joined by my colleague Katlego Mei. Katlego, thanks for joining me again. I appreciate it.
Thank you for having me, Warren.
So let's kick off our first question.
Hi, Warren. Thank you so much for all the awesome info that you provided for us on your podcast. It really is amazing. My question to you is based around foreign investment and the two main options we have, being the rand-denominated ETF, feeder funds, or a dollar-based ETF. I'm investing on the Easy Equities platform, so we have both options available to us. Just to give you some background, I'm a farmer, which means that around about 80% of my assets are tied up in land and livestock in South Africa. My main priority now is to diversify my investments, and especially I feel a need to hedge against the rand. I've no intention of leaving the country. I love my country, and I plan on living here for the rest of my life. Why then would I consider a US dollar account option as opposed to just investing in feeder funds, which should hedge against the rand adequately? I'd be very interested to hear any opinion you may have on that. Thank you very much.
Thanks. That's a brilliant question. I think there are quite a few topics to touch on there, Katlego. But let me give it my first shot and then jump in when I go wrong. So I think the first comment is maybe to start near the end of your question, which is, if you've got 80% of your life, in other words, your land value, your business value, your home value, all of that stuff, if 80% of everything is invested in one country, it doesn't matter what the country is, that's too much exposure to be invested in one place. It's just too much risk to take in one little small little country on the tip of Africa when we've got this whole globe, and I think that's the first comment is, diversification is a really critical point in investments, whether it's diversification across cash, bonds, property, shares. It's also diversification across countries and different economies. And so my main point here is you need to get the diversification, and that's a real benefit. And then it's about the mechanics. It's about how you get the diversification. And I think that's maybe to get to the crux of why would we invest in a dollar-denominated fund overseas versus a rand-denominated, what you called a feeder fund, which is absolutely right. That is the right jargon. And just to explain for people that don't understand what a feeder fund is, that would be a rand-denominated fund that you could buy in South Africa, but it's fully invested in international markets. So, for example, like a world index or a global tech index or whatever it is, those are generally invested around the world, generally priced in dollars, but you can buy it with rands from a South African exchange traded fund or a South African unit trust. Now, why should people have one or both? And my view is, if you want to save on a monthly basis, let's just say you've got 1,000 Rand a month to save, it's really expensive to go to the bank to convert your rands into dollars, send the dollars out, and then buy a dollar-denominated unit trust on the other side. Firstly, the banks are going to charge you a lot of money to convert your rands into dollars every time. And secondly, a lot of these funds overseas will have a minimum amount. They'll say, for example, that you can only invest $1,000 as a minimum in our unit trust or something like that. And so practically, it just makes more sense to do a monthly debit order into a feeder fund that you spoke about. I like doing that. But if you've got a larger amount, so let's say you've got a lump sum and it's 500,000 Rand or R1 million or more, why would you then not just do the feeder fund? Why would you go overseas? And I think the main point here is we never know what happens to any country. And understanding in South Africa is we live in a really quite volatile political system where we're subject to a party, and at the moment it's the ANC, and they're economically they're relaxing exchange controls and all of those things. But in the future, it might be a different political party. And what happens if they implement stronger or tighter exchange controls? What happens if they make it difficult for us to buy feeder funds or to get overseas exposure? And that, I admit, it's an unlikely event. But the point is, when you're investing and you're spreading your risks and doing diversification, the reason you're doing that is to protect yourself against the unlikely things. And that's what I'm talking about here. So when you've got larger amounts of money, I think it makes sense to get the money invested overseas, get it invested in a low-cost place, but make sure that it is in a country that doesn't tax you as a non-resident there. So that's always a danger. A lot of the time people might invest money overseas and suddenly they find they're liable for income tax or capital gains tax or dividends tax or death duties because they were non-resident in let's say the USA or the UK as an example. So make sure that the money's invested tax effectively. But I think my main point there, and I know I'm talking a lot, Katlego, I'll give you a chance now, but my main point there is we're diversifying against unforeseen risks that we just can't predict today. And that might be the biggest reason. I don't know if you disagree.
No, I absolutely agree with you, Warren. I think it's important to remember that South Africa makes up a tiny percentage of the world market. So you do want to ultimately, at the end of the day, by investing in other countries, diversify your portfolio, meaning giving you exposure to a wider range in the basket in the world market. So from a diversification perspective, absolutely makes sense to go offshore, especially in this particular case where 80% of the guy's wealth is sitting in South Africa. So he does need to externalize some money. And then I think it's important to remember when investing directly offshore that there are certain rules and regulations. You don't want to get into trouble. So the Reserve Bank and so on, you can take, I think, R1 million it is in a calendar year. So between January and December offshore. That's if you are going to buy dollars and invest offshore, that's R1 million. Important to remember also is that includes your travel. So if you are your travel allowance, if you are going to travel to other countries, so just make provision for that in that R1 million. And then anything over and above that, you're going to need to apply to the Reserve Bank so that they can give you permission to take up a little bit more money. I think it's up to 10 million. 10 million it is. So from that perspective, it makes sense for me for people to invest their money offshore.
Well, I think we've answered that question. It's a brilliant question. Thank you so much, and all the best with your farming. Must be tough being a farmer when you're always dependent on the weather and the food markets, etc., etc. So we wish you all the best, and please send us questions in the future if you've got. I think I'm going to jump on to the next question now.
So, what are some of the best options to preserve a big amount of capital for passive income?
Katlego, a big amount of capital for a passive income. I think firstly, do you want to break down what that means for our listeners, and then let's look at some options?
I think that means when you've got some money that you're going to put away, but you want it to pay you an income on an ongoing basis.
So thank goodness it's money that'll be working while you're not. You're not dependent on your own efforts to generate an income. Somewhere along the line, you're getting an income from your capital, whether it be interest, rent, dividends. I think those are the main forms of income from capital, what people would call passive income. So what do we do here? What are some of the options that someone can consider with a large sum of money?
So, of course, it depends on individual circumstances and what the situation is. So, are you still earning an income while you're earning this passive income? Or is it a question of you not really dependent on that income? I think for people that are investing this just to earn a passive income while they're making other income, the scope is broader. But there are a few options like unit trust accounts, where you can invest your money in a unit trust or an ETF, depending on how you feel about these things. Generally, you want to keep costs as low as possible. So then you can go for the ETF or the index funds. And then from those funds, you can either decide if you want the income that's coming in to be reinvested, or if you want that income to pay you out on a month-to-month basis, then you can put what they call a regular withdrawal on that type of investment.
I think, maybe to add to that, if you've got a large sum of money, the first point is make sure that you spread your risks. So even if you've got a lot of money, you might be tempted to say, well, I've just seen a house for sale in Camps Bay, and I'm sure I can rent it out for a lot of money every December and every other holiday season, and that'll be a great way to earn income. And when the house is empty, I can go and have a free holiday. Might sound like a good idea, might sound very attractive, but the issue there is you've now taken every single one of your eggs and you've put them in exactly one basket, and if something goes wrong, then you potentially lose a lot of money. So the first comment there is going to be make sure that you spread your risks, and that's why I think I like your point, Katlego, about saying if you look at a unit trust or an exchange traded fund, where on its own it's already invested in a lot of different things. It's not just invested in one thing. So that spread of investment is important, and then I think just understanding how you generate your income. In time gone by, we could have said, well, look at, for example, buying a property exchange traded fund, which is a property index that, let's say, owns office parks, it owns, shopping centers, storage spaces, and those kinds of things. The problem at the moment is that we look at the sector and we say, well, lockdown happened. And we're living in the middle of lockdown, and we don't know whether we're going to have 1, 3, 5, 10 lockdowns. We just don't know. And so those property prices have fallen a lot, but so have the rents. And so if you were invested and you had all of your eggs just in that listed property basket, unfortunately that basket is halved in value, and so is the rent that you're earning from it. So just be careful that you don't take too much of a bet in one section. So what I would say is, I think I like the idea of, for example, a balanced portfolio where you've got some in property, some in cash, some in government bonds, some in shares, and making sure that you've got a little bit of a bias to the assets that are going to grow faster than inflation. And generally, over time, the things that grow faster than inflation are shares and even property companies, even though they've had a terrible time in the last few years. And so, spreading your assets makes sense, and that's the one way. We can explore, for example, buying into a private business, and there's nothing wrong with doing that to earn an income. Just be careful of the diversification risk again, because now if you're only buying it into one private business, you've put all of your eggs again into that one basket, and so for me that's a little bit of a concern. And then I think the last point is, you need to probably, if this lump sum is your only source of income, Make sure you've got a portion of it invested overseas, because the diversification of asset types can happen in international markets as well. So, for example, you can buy international property companies, international shares, where potentially the dividends are a bit higher than South Africa, and the way that they grow is very different to here. If you're growing, for example, in a Taiwanese semiconductor business, which makes computer chips for gaming companies, that's probably really growing really fast compared to a small little company in South Africa, that sells hand sanitizer, as an example. And so you want that nice spread. But I think that's the crux for this. Don't be too clever. Don't be too cute with the money, because you've got this money. You need to protect it, and that means the diversification. And I like your point a lot, Katlego, on saying don't focus just on the income, because maybe what you can do is get quite a lot of growth and then sell a few shares or sell a few units of an index every now and then to top up the income that you get. If the growth is faster than the inflation rate, why not? That's quite a tax effective way. Any other comments for this great question?
No comments, but just a word of caution. So if you are going to go into a single asset, be it a property or a business, just be sure to do your due diligence, do your homework, make sure you know what risk you're taking and you're comfortable with that risk.
Fantastic. I think we've got time for one more question. So let's hear the next one.
Morning, guys. All I want to find out is where to invest if you want to get the compound interest. I just want you guys to explain to me in simple steps which bank account or which type of investment can you choose in order for you to be able to earn compound interest. That's my question.
Katlego, compound interest. What's the best place to get compound interest?
I think, Warren, it's important to clarify here. I think we need to first discuss what is compound interest or compounding growth, and then discuss a few options where you can invest.
It's your show. Let's hear what you got to say.
So compound interest or compounding growth is growth that you get by investing in a particular asset, call it a share. So every time there's growth on that share, you reinvest it or you keep it invested and it keeps on growing. So you're getting growth on capital plus your previous growth, whether it was income or dividends. So that's called compounding. So you getting interest or growth on growth.
I've got a great example for you, and I know this is close to your heart. You buy a bull and you buy a cow. They have a baby, a calf. And so you've bought two things and suddenly you've got three things, right? So without doing anything, you didn't buy the calf. The bull and the cow made the calf. And in the money world, that's compounding, right? That's you've bought something, it's grown itself, and so we get to the eighth wonder of the world, which is this compounding. I think one of the banks used to run an ad where it says, "Let your money make money babies," and that's exactly what we're talking about here. It doesn't have to be just on cash. So for example, it's not just putting money in the bank where you earn nowadays a terrible rate of interest and then the interest grows on itself. So you get interest on your interest. It could also be in a share where you buy the share goes up in value. So it goes from 1 Rand to 2 Rand, 2 Rand to 4 Rand, 4 Rand to 8 Rand. That's compounding. So it doesn't have to just be on cash. And I think that's the important point that you're making here, is that people often think about compound interest only, as in it's only interest that I'm earning, but this is growth. It can be actually on shares, unit trust, exchange traded funds, or a bank account, or a fixed deposit.
Yeah. And I think it's also important for people to be aware of the converse. So you get what we call simple interest as well. And how that would work is when I tell you, okay, Warren, I'm going to give you my 10,000 Rand, and then you promise me 100 Rand at the end of the year. And that's all I'm going to get. So that's called simple interest. We work out a percentage on the capital that I'm investing, and that's all I'll get at the end of the term. So in that example, there's nothing there compounding. So the growth is not growing itself. I'm only getting a certain percentage on my capital.
Okay, I think that's a great point. And now that you've given the academic background, where should our listener get the best rate of compounding?
That's a tricky question.
That's why I asked it.
So I think it depends on the term and sort of your goal. What's your goal for that investment, right? If you are using it for your emergencies or your emergency fund, it's not really clever to invest it in a high risk type of asset because you might need that money at any time. In that example, then it's okay to go with the lower rate of interest that you'll be getting from, let's call it a bank or money market fund, whatever. So the term of your investment there determines now where you are putting that money, which is in cash or money market type funds. Once you start looking at the longer term, meaning 5 years plus, then you should start considering a basket of assets that does include shares and listed property, because they are called your growth assets. So they drive growth over the long term. And then you need exposure to that range of investments.
So I think that's a great point. If you want the best rate of growth, if you want the highest compounding, that means you need to take a bit of risk, and the more risk you take, the longer you need to invest the money for. So if you've only got 1 year to go, if you need the money in 1 year's time or 2 years' time, the best thing you can do is shop around at the banks and the unit trust companies to look at what interest they're paying on money market accounts, because that's probably where you're going to get the best rate of growth for short periods of time. But if you've got 5, 10 or 15 years, look at exchange traded funds or unit trusts that invest in shares, because that's where you'll get the best growth over a long period of time. Unfortunately, it does come with risk, but the longer the time frame, the less your risks will be. So I hope that helps. Unfortunately, it's a great question that you asked, but there are lots and lots of answers, which is why it sounds like we're sitting on the fence a bit. I think that's all we've got for the show. Thank you so much for your questions. I'm sure we'll be doing some more in the very near future. Please keep sending them in to @honestmoney. We've got our WhatsApp number there where you can send your voice notes. Really appreciate all your interest and looking forward to hearing more of your questions. Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @WarrenIngram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.